Hello, everyone. Now you get to listen to the accountant. Actually, we're very grateful for Debbie asking us to present here tonight to talk about the tax ramifications of cancellation of real estate debt. And when I say we, we is Kim Hughes. Kim Hughes is a tax professional in our Casa Grande office here. And at the end, if you have questions, ask Kim. If you want the right answer, ask Kim. She's the smart one. So anyway, I might be the favorite one, but she's the smart one. Anyway, tonight, let's see if I can get this. There we go. Cancellation of debt. Let me give you 3 letters. IRS. Does that give you a warm and fuzzy feeling when you hear IRS? Yeah, not really. And why is that? Well, it's because the way the IRS looks at things. If you say cancellation of debt to the IRS, what they hear is income. Okay? And technically, it is income to the extent that it's forgiven, the amount is greater than the asset you might give up. So there's different ways to have cancellation of debt. And basically what it boils down to is a lot of the things you heard tonight: foreclosure, bankruptcy, loan mods, all those things result in cancellation of debt. However, our friends in Washington, even though they look at it and they hear income, what they have said is, and what they've come up with are some ways that it might not be taxable income. Okay? And so that's what we're here to talk about tonight. There's some common exceptions, and as I'm just going to say, as my friend David said, everybody's situation is different. I have to say that. You know, it's really hard to give tax advice in a group setting, and so I'm not going to give tax advice in a group setting, because I guarantee you everybody is going to have a different situation and a different result. But some of the exceptions that make the income from cancellation of debt are qualified principal residence indebtedness. It's basically what we've been talking about tonight. Bankruptcy or insolvency. And then finally, we have qualified real property business indebtedness. This really comes down to, is it business property, not your home, but is it trade or business property? There's some other ones as well. I get into recourse, non-recourse, but I just don't think we have time to get into all that tonight. So let's talk about these. The qualified personal resident indebtedness provision was added in 2007. It's the Mortgage Forgiveness Debt Relief Act. And that really is what we're talking about when we say, hey, I'm giving up my home, I'm going through all of this pain. Is it really fair now, IRS, to come along and say, hey, I'm going to tax you? Well, not really. There's certain circumstances where their taxable income is created, but the debt must be secured by your principal residence. It can't be more than the cost of your principal residence plus improvements. And it's debt secured by your main home that you used to refinance a mortgage, but only up to the amount of the old mortgage just before the refinancing. So what does that mean? Well, essentially what that means is if you went, so you have your first mortgage, then maybe you went out and got a equity line of credit, and you got some money out and you used it to pay off credit cards. Well, basically, if you have, let's say you have $200,000 of debt, your house is worth $100,000, but of that $200,000 in debt, along the way you took out a second loan and you paid off $50,000 in credit cards. Well, if that $100,000 is forgiven, 50,000 of it will be taxable because it wasn't used towards the purchase of your home or improvements in your home. Basically, I'm not going to go through this too much. When we get into rental real estate, pretty much most of the same rules apply. Rental real estate is considered to be used in trade or business unless you use it for personal use more than 14 days. There is an exclusion for this on the debt forgiveness, and the exclusion is limited to the adjusted basis or depreciable real property before the discharge. Whew. What that means is when you have business property, you get to depreciate it. That depreciation is an expense. So essentially you have to recover that expense that you were allowed to take, and that's going to get included back in income. Okay? The other exclusion is, of course, the fair market value less the debt forgiven. I think that's it for me.
All right.